Hi, guys. Thank you for joining us today. This is another podcast with Elena, and today we're going to be talking about zero down loans. Everybody's asking me, how can I get a house if I don't have enough for a down payment? So today I'm going to be talking just about this issue, and I invited Katie with us. She's a loan specialist, and she's going to help us to understand what are zero down loans, how they work, who can use them, and whether or not they're a good idea to use or not. So today is 2021. I'm hoping that in your New Year resolutions, you made the resolution to buy a house this year. To help you to get started, let's look at our options. So my name is Elena Garrett. I'm a realtor with Keller Williams Central. Just to let you know, I have several newsletters that are coming out every month. I have several Facebook groups. I'm not going to go over them. They're on the screen and there will be in the description below. Also, I have my own YouTube channel. You somehow landed on this video. So if you click on the link under this video, you're going to see other videos that I provide. Most of them are focused on how to buy a house with creative financing, difficult financing, potentially difficult credit. So if you feel like you need one of those videos, make sure to watch the rest of or to scroll through the rest of the videos in my channel. My guest today is Katie Andy, and she's a loan specialist with Interlink Mortgage. Katie, would you like to introduce yourself?
Absolutely. Thank you so much, Elena, and thank you for having me today. Hopefully we can add some value to your clients and just people out there who come across your video as well. So my name is Katie Andy. I'm with Interlink Mortgage, and I've been in the mortgage industry for 23 years this year. I started out as a mortgage processor and then eventually earned my delegated lending authority to underwrite VA, FHA, and conventional loans before I ever moved onto the front line in origination. So I've really found a passion for helping, especially first-time home buyers and buyers who have credit challenges. I just find that, they understand that they need a professional to help them through the process. And just with my background and knowing what underwriters are actually looking for, I've been able to help so many families get into homes. So I'm excited to actually talk about these topics, especially the zero down payment assistance programs and stuff like that. So I'm excited to go over that with you guys today.
Cool. Without further ado, then let's get started. So tell me about zero down loans. And when I was in training for my real estate license, we talked about the three big zeros, right? They were FHA, VA, and USDA. So can you tell me more about those? And what
I
are
can.
what are those words stand for? Everybody is so confused.
So USDA is actually United States Department of Agriculture, which a lot of people are kind of surprised that they would have anything to do with home lending, but they do. And so there are some special nuances. It is 100% financing. So it's a zero down payment program. You still are going to have closing costs and prepaids as with any loan, but you don't have a down payment. So that is one of the unique things about USDA. It also has to be on a geographic area that is classified as rural. So there are some special restrictions as far as where the property is located. So it may not be eligible to somebody who's buying where it's a highly populated area. The other
Mm-hmm.
thing is USDA will allow for manual underwrites down to a 620 credit score, but typically for their automated system, they want to see a 680 or above to get that, to have a little bit of room in the ratios. So they do have income restrictions based off of your household size and the county. And so basically we have an eligibility simulator that we run whenever we're talking to somebody, and we'll plug in their household size, their income, and where they're looking to buy, and it'll tell us whether or not their income meets the program requirements. The other thing is it can only be used one at a time. Like you can't have another home at the time you use USDA. So, on other programs, for instance, like VA or FHA, it's fine if you own another property, you can rent it out instead of selling it. But on USDA, you can't own any other property. And one unique thing about USDA that a lot of people don't know is the property can't have a pool. And I found that out the hard way years ago doing a deal. So it's just one of those unique things about the program. But it's a great product for buyers who have a little bit stronger credit, who have low debt to income ratios, because the program really doesn't want to see more than about a 41% debt to income ratio on that program. And it does allow for the seller to give concessions up to 6%. So closing costs and prepaids can be negotiated with a seller. And so it really could be a true zero out of pocket if you combine the fact that it's a zero down payment, and if you have a seller who's willing to give closing costs and prepaids, a buyer really could get in for nothing out of pocket at the end of the day. Now,
question to you on that one. Are there any top, like, I know that for FHA, we have the top loan amount being, what is it right now, for 5,500 something, 509 or something like that, right?
Yeah.
Depends on the county too. Right, but depends on the county too. But for USDAs, like if I see a house that is 307, for example, is it within the USDA guidelines?
So basically, it's kind of the same thing where you would run the eligibility on that. There are some price restrictions, like you can't use USDA on like a $500,000 home and get zero down financing. It really is geared more to your low to moderate income households. So it's going to fall along the same lines as like an FHA loan is, as far as income loans go.
Gotcha. Yeah. Alrighty, then let's move on. I had more questions. I have a lot of people asking me about USDA loans, which is why I included it in the presentation, but go on.
Well, it's such a great product. And the thing is you don't have to necessarily be part of a specialized group, which the other two that we're about to talk about, VA, of course, you have to be a veteran. That's only going to be eligible to veterans. It's a benefit of serving in our military. So with VA, again, it's a zero down payment requirement. The seller on VA is allowed to pay up to 4% plus title on the loan, you know, to help a veteran with their closing costs and prepaids, because they're still going to have that. There aren't any income restrictions. The VA loan limits are, they match along with the conventional loan limit. So they're actually higher than FHA. The minimum FICO score right now, provided you can get an automated approval, is 600. So it gives you a lot of flexibility there. You don't have any restrictions on where the house has to be located. And a veteran can use their VA eligibility more than one time. So they basically, there's a formula for the amount of the entitlement that they use on a home. But let's say they buy one home, you know, that's 130, and then a few years later they decide they want to upgrade, but they want to keep that as a rental. They may still have enough entitlement to use their VA again for the next purchase. If they do not have enough entitlement left, then they would have to sell their current home or refinance it to conventional in order to open up their VA benefits again to use on another home. The other thing that's unique to VA, and I'll go back to this on USDA too, USDA does not have private mortgage insurance, and neither does VA. So VA has what's called a funding fee, and it's VA's guarantee of the loan. If a veteran has more than a 10% disability rating, they're exempt from that. But if it's a first time use and they aren't exempt from it from a disability rating, then the funding fee is 3.4% of the base loan amount, and it's financed into the loan. It's not a hard cost out of pocket. It's just paid out over the life of the loan. But that's since VA is guaranteeing the loan, it's their insurance, if you will. And there's no monthly mortgage insurance at all on VA, which that is the only zero down program out there for the most part that has that feature. USDA does not have mortgage insurance, but they do have a guarantee fee. It's 1% of the loan amount that's financed in.
That's kind of reasonable.
Yeah, reasonable. And then they have a small monthly mortgage or guarantee fee that's 0.35% that's paid in monthly. So it's still a lot lower than, say, an FHA loan, and especially for a zero down product. So, you know, let's jump into FHA, right? So FHA, you don't have to fall into any particular category to get FHA financing. The down payment program assistance programs that we work with are Texas State Affordable Housing, Texas Department of Housing and Community Affairs, and then SETH, which is Southeast Texas Housing. So those are the three primary Texas down payment assistance programs. Some of them are just for first-time homebuyers. Some of them are for your teachers, firefighters, police officers, your first responders, your veterans. And they do have income restrictions based off of household size and county. So that is something that we would take a look at. And then all of them require at least a 640 mid score in order to do a down payment assistance program. The 640 mid score, buyers are going to be limited to 45% combined debt to income ratio. If their credit score happens to be 700 or above, we can go off of the automated findings up to over 50% debt to income ratio. So credit score is really going to play a part in those down payment assistance programs. There aren't any restrictions as far as where the homes are located. And you don't necessarily have to be a first-time home buyer to get down payment assistance. We just closed a gentleman last week that he actually had a condo that he owned free and clear that he wanted to keep as a rental, and he was able to keep that and still take advantage of the teacher's down payment assistance program because it doesn't have a first-time home buyer requirement. So, you know, used to those programs always required that you were a first-time home buyer and hadn't owned a home in the last 3 years, but they've really opened that up to make it more accessible to the general population. On the different down payment assistance programs, typically you can get anywhere from 3% to 5% in down payment assistance. They're going to be in the form of either a grant or a forgivable second lien or a non-forgivable second lien. So each of the programs have their own specific parameters, and that's something that a buyer is more than happy, you know, they're welcome to call me because I can talk about those programs for an hour just on their own. But that's something that, I mean, I'm happy to answer those questions. They can contact me outside of the call. But basically with FHA, the thing to understand is FHA, even with the down payment assistance programs, it's not a zero down, but FHA is 3.5% down. But if you pair that with the 3% down payment assistance option, they're going to only have to pay 0.5% in down payment. If they combine it with the 4% down payment assistance option, is obviously going to cover their full down payment. And then the 5% down payment assistance option is going to cover not only that 3.5% down payment, but also 1.5% in their closing costs. And of course, with FHA, seller again is allowed to contribute up to 6% towards closing costs and prepaids. And so paired with the down payment assistance program, and if you have a seller who's willing and able, you can actually, just like VA and USDA, structure it where the buyer really is zero out of pocket at the end of the transaction. But they definitely, each of them have the ability to minimize the burden of having to come up with a large down payment.
Gotcha. This is actually a very important distinction between zero down payment and zero out of pocket, but we're going to talk about it just a little bit later.
Absolutely. And one product I want to mention, because this is unique to Interlink, and so it's not on the general slide, but we did just roll out last year 100% no MI conventional product. It's a little bit
conventional.
Yeah. So it's a little bit stricter in qualifying. You've got to have at least a 660 mid score. Maximum debt to income ratio is 43%. It is manually underwritten. It's not automated. This is private money. So the rate on it's a little bit higher than what you're going to get in regular market. But when you look at the regular rate with the MI, this actually comes out better. And especially considering that historically, mortgage interest is tax deductible, whereas mortgage insurance is not. You know, tax codes change from time to time. I know right now under the current tax code, you know, with what people get in just the general, I'm drawing a blank on the name of it, but instead of doing itemized deductions, you get just that general amount. They've taken out, you know, the benefit of really writing off a lot of stuff. But the thing is, it's different, and administrations make changes to tax codes all the time. And typically tax codes have been more friendly towards homeowners because you get the benefits of writing off your real estate taxes and your mortgage interest. Mortgage insurance has never been tax deductible. So it does give you, you know, some benefits there. And
I didn't know that. I actually didn't know that.
Yeah. And then
about the mortgage insurance.
Absolutely. And then that program too, we allow the seller to pay up to 6%. So it's another one that you could structure for zero down. So where that's one that has really helped is for my buyers who maybe are looking in a USDA eligible area, but maybe their income is too much.
I actually have maybe a buyer just like that.
Well, definitely let's touch base outside the call, because that program doesn't have any income restrictions and it doesn't have any home buyer, you know, you don't have to be a first time home buyer. It's just a true 100% no MI product, and it's conventional. And like I said, it's manually underwritten. So it's a great option when you compare it to like even the USDA or FHA with down payment assistance.
Gotcha. All right.
Without the income restrictions.
I might need to have a separate either chat online with you,
Yeah.
on our YouTube or not, because that is now those three that we just covered, they're very standard. What you just told
Mhm.
me actually helps some of my buyers whom I told, unfortunately, your income is too low. You make too much money. You
Yeah.
qualify for some of those programs that would help them. But let's move on then, so we can look at more details on those loans.
Absolutely. So basically, we went through what the big three are that everybody
Mm-hmm.
kind of is aware of, is your USDA, your FHA with down payment assistance, and your VA.
Mm-hmm.
So it's important to understand that, some of these are going to be with grants, and some of these are paired with a second lien. The second liens on these programs are zero interest, so they're not having to pay any interest on the second lien. But some of them you have to stay in the home for 3 years, and then it becomes forgiven, which, if you think about it, if you get a 5% in down payment assistance, let's say it's a $15,000 second to cover your down payment and the majority of your closing costs, and you don't ever have to pay that back after you've lived in the home 3 years, that's amazing. And so that's something,
Free money. Everybody
for
who's listening
real.
to this,
Yeah.
if you don't understand what the terms means, let me translate it for you.
Yeah.
Free $15,000 for you from the government.
Yeah. I mean, it's a great product. And of course, some of them, if they don't qualify under that product, you do have additional options where that it is repayable. So you have to pay it back whenever you either sell your home or once the primary loan's been paid off. But that would be something that each person that we look at, we're going to look at which programs they qualify for and match them up with the best option for them. Some of the programs will allow for co-signers on the down payment assistance programs. Co-signers are a little bit tricky because they cannot take occupancy to the house or title to the house if we are going to meet income guidelines. Okay, so for instance, now if you have an occupying co-signer and just somebody who's going to, 2 occupants or 3 occupants, they're all going to live together, all of their income, all of their credit, everything has to meet the program guideline. So, you start getting 2 or 3 people buying together, their income might be over the limit. If it's somebody who's a non-occupying co-signer, which the bond programs do allow a non-occupying co-signer, and the non-occupying co-signer's income is not taken into consideration in the household income because they don't occupy. So they don't have to meet the income. They're not part of the household income restriction. So you could have somebody who's maybe low to moderate income, who has maybe a mom or a dad who makes a lot of money, who's helping them co-sign to get ratios in line, but mom and dad's income is not going to restrict them from qualifying for the down payment assistance because they aren't occupying or taking title to the property. So that is something that's a little bit unique.
So can anybody be a co-signer? Because I actually have a friend, a very dear friend of mine. She's a single mom with a cancer-stricken kid living in a tiny little apartment, and she doesn't have the down payment. I know that she has low credit debt to credit ratio, but she has very little left over from her monthly expenses. And I would say maybe I can do a co-signer for you to help you qualify for the down payment assistance, but I am her friend, I'm not a relative.
Right. So eligible co-borrowers and co-signers, if you are occupying the
I'm not.
you do not have to be related.
Okay.
If you are not occupying the house, if you are a non-occupant co-signer, you have to be related by blood, marriage, or adoption. And they're very strict on that in order to do the minimum down, right? Now, if somebody's doing 15 or 20% down, we can document, like you might have somebody who's considered an auntie or an uncle that maybe has been a longtime family friend, maybe they're a godparent, something like that. We've had documented cases where we've been able to make exceptions in those instances, but they've got to do at least 15% down. They're not going to be able to have somebody who's a non-relative be a co-signer and get the benefit of a 0 down or a 3.5% down.
Gotcha.
So those are the restrictions, as far as co-signers go. But, we're going to look at each applicant individually on their scenario and see what will work and what won't. But just because they need a co-signer doesn't automatically disqualify them from being eligible to utilize a down payment assistance program. Now, going back real quick, VA does not allow co-signers unless unless it's the married spouse of the veteran. And that is because VA is a veteran benefit. So benefits are only eligible to the veteran and their spouse. So you can't add a non-occupying or even an unmarried occupying cosigner on VA loans. USDA
So
also
a girlfriend and a boyfriend, they would not be able to, right?
have to be married. Even if they are engaged, they cannot do it. They have to be married. And that's just one of those rules that VA has. And it's again, because it's a benefit. And just like, you know, you have to be married in order to get any sort of housing benefit or disability benefit. Same thing. It's just the mortgage, the VA mortgage is a benefit to a veteran who has served and to their spouse, and that's it.
Gotcha.
That's unique. And then USDA does not allow for cosigners. Yeah.
So those are right. So FHA is the best option for most people. It looks
if they need a cosigner to help them qualify, FHA is going to be the better route to go.
Gotcha. So let's just say that we're having somebody in here who wants to try to find out if they would qualify, because a lot of people don't know if they qualify. And most people, when they tell me that I don't have a down payment so I can buy a house, I'm like, you might be able to qualify for down payment assistance. You know, like, well, I'm afraid to call a lender because then they're going to pull my credit report and my credit will be ruined forever and ever. So tell me more about that.
So it's such misinformation. So many people I talk to, they have that fear of, well, I don't want my credit pulled because it's going to drop my score. So first of all, let me just debunk that myth. So a mortgage inquiry is only going to impact a consumer's credit score between 1 and 7 points. And it could be a positive or a negative impact on their credit score, depending on their overall credit profile. If they haven't had any inquiries in a really long time, sometimes an inquiry from a mortgage company will actually boost their score that 7 points versus dropping it. So you can't just automatically assume that it's going to drop your score. But the other thing too is consumers also have the ability to shop mortgage lenders within, you know, a 15-day window and have more than one mortgage company pull their credit and it not impact their score more than just the one time. So that should never be something that prevents somebody from having an honest, transparent, meaningful conversation with a lender. And certainly, you know, they're going to want to talk to a high trust relationship. Calling, you know, some of the online lenders and internet lenders and things out there. Most of those loan officers, it's order taking, right? And so they're really just looking for the top, you know, credit scores and high down payments. They're not going to get into the specialized programs and the down payment assistance programs, and they are paid by the phone call. So they're not going to spend a lot of time doing a consultation or advise your client. So, you know, you've got to, that's one thing is anytime you're talking to somebody who's potentially buying is helping them understand the difference between
lending tree and
yeah, I was trying not to mention any names, but yeah, so it's just you have to know that there's a different, you're going to get a different level of service working because there's mortgage brokers out there, there's mortgage bankers, then you have your online lenders, then you have your big banks.
Most people don't know any difference. All they know that on Zillow there is a button that says check, you know, check if you qualify, and of course the word check is like a command, like yes, check, I'll check. And that's where I see that they actually tell me I did not qualify. Well, how do you know? Well, I checked online.
And a lot of times, I cannot tell you how many times that I've had buyers who have gotten denials on FHA and on VA and even on conventional loans because the lender online has credit score requirements that are higher than what the actual program is. Because that's another thing that people don't understand is different lenders have different internal overlays. So I can go down to 580 on FHA because we sell direct to Jenny and Fannie and Freddie. So we don't have overlays on our programs. If we have an automated approval and it meets the program score, we move forward. But there are lenders out there and there are banks out there that, hey, we don't want to lend to anybody under 680. And so they might be at 660 and tell them, no, we can't qualify you on VA because they're under that 680. VA goes down to 600 with an automated approval. So they just need to talk to the right lender who doesn't have those overlays on scores. But that's probably another topic that we could get into. I
really think that topic deserves its own discussion. And I want to do a separate video on it because I was talking to a gentleman the other day and he said, I already called the lender and they declined me. And I said, did they give you a reason for decline? And they said, I don't have 20% down payment. I'm like,
Yeah, I get that all the time. And again, they need to talk to somebody who has multiple products and
mm-hmm,
also can give them a little bit of guidance. I mean, that's one
mm-hmm,
thing that we will take a look at is what programs are available. Somebody might just be 10 or 15 points off from where they need to be to qualify for
mm-hmm,
down payment assistance. And we have the ability to run the credit simulator to see if we
mm-hmm,
can pop their score up. And we're not a credit repair company, but we can
mm-hmm,
do that simulation and say, hey, if you paid this down or negotiated a settlement on this, it'd pop your score up. And then we could look at those programs. So we really do try to be an education source and a trusted advisor. It's real easy, especially with volume that comes in right now, because everybody's looking because rates are so low. It's real easy for people who get real busy to start cherry picking and not wanting to put forth the effort on the first time
mm-hmm.
buyers and the buyers that maybe have a few challenges. But again, that's where working with that high trusted professional is going to come in, and knowing that who you're putting them with is going to, give them the same level of service regardless of where they are in their journey.
But let's just say that now they're watching this video, they say, okay, I feel like I now feel urged to go ahead and try to see if I can qualify. What's my next step?
So really you would just have them get in touch with me, or,
Mm-hmm.
it doesn't have to be me, but I mean, basically if somebody wanted to see what we could do, I have a website that I would direct them to do the application. That way we can pull credit. We do full pre-approval. So we do want to gather the pay stubs for the most recent 30 days, W-2 forms for the last 2 years, tax returns for the last 2 years, bank statements for the last 2 months, and then their identifying documentation, driver's license, social, green card, whatever's applicable there. And then if there's anything pertinent that we need to know, like are there divorce decrees, child support orders, bankruptcy docs, things like that, we'll want to take a look at those as well up front. The reason that we do that is because if we were to just basically look at the credit score and just a snapshot and issue a pre-approval and then find out 2 weeks into contract that they've got a child support, order, or, a variety of things. There's so many different things. So we try to analyze everything up front. So at the time we issue that pre-approval letter, they can go out with confidence. You can go out with confidence knowing that if they get their offer accepted, they're going to close. Because that's probably one of the biggest things that we run into with just basic pre-qual letters in the market is you'll have lenders that just issue these pre-qual letters without really doing a deep dive on what's going on with their whole situation. So, our turn times on pre-approvals right now take 48 to 72 hours. We're not turning them around in 3 hours, because we are taking the right time, even with the higher volume, to do right by the buyer and make sure that we've analyzed everything. So that really is, and here's the thing is, a lot of times I'll get first-time home buyers that don't necessarily know that there's even programs out there that can help them. So that's another thing that I look at as my role, is to say, hey, this is what we talked about. These are the programs that you qualify for, and then showing them the pros and cons of each. And I think that if we go on to the next slide, I think that's one of the things that we were going to talk about is when does it make sense? I think it might be further on, but that's okay. When does it make sense to use a down payment assistance program versus when does it not? If somebody's got super strong credit and they have some money to work with, then doing a down payment assistance program may not be the right option for them. And doing a zero down may not be the right option for them. The zero down payment programs, the down payment assistance programs, the rates are going to be a little bit higher than what you're going to get in the regular market. So for instance, right now for an FHA buyer who is, let's say 660 on their credit score. So they qualify for down payment assistance because they're above 640. But let's say they're doing a 5% in down payment assistance. The rate on that right now with the bond programs is 3.375. Whereas a regular FHA right now at 660 is closer to about 2.75. So they're paying, a little over a half a point more in the interest rate, but they're getting 5% in down payment assistance. So you kind of have to look at how long are they going to be in the home, short-term and long-term, benefits of using the program. If they're going to be there, is the down payment assistance forgivable? If it's forgivable after 3 years and they're going to be there 5 years, paying a little bit higher rate is not a bad thing at all. But let's say they don't qualify for the grant or the forgivable second. If they're going to have to repay that and be at a higher rate, and they're only going to be in the home for a few years, but they have their own money now, it might make more sense to just do their own down payment and get the lower rate and not have to worry about paying back a big lump sum whenever they sell the house. So those are things that we're going to analyze whenever determining whether or not just because they qualify for it doesn't necessarily mean that it's the best program for them. But we're going to explore and say, we're going to find out where they want to be on payment, what they have to work with, which programs they qualify for, and then match them up based on that information to the best ones, and then go over the short-term and long-term pros and cons of each. That way they can make an educated decision on which program they want to go with.
This is actually what I think sets you apart. And if you noticed, I send you quite a few people.
Yes.
And you're not the only lender that I know, but you're the only lender that I know that takes time to educate them.
Yeah.
That's why I send you so many people.
And a lot of that, like I said, it comes from my background. I mean, having been a processor and underwriter, I look at files a lot differently than somebody who's coming at it just from sales. And, you know, most loan officers in the industry started out in sales and moved into it from sales. And so they might have just kind of a basic working knowledge, but they don't understand necessarily the deep dive and what happens once it moves to the processors and underwriters' desk.
Actually, that is my biggest complaint about some of my lenders, is that they issue the pre-qual letter in 2 hours, and they tell me they can close in less than 20 days. And I'm like, I'm scared. I'm scared to put this on a contract. But never mind. So, but let's go on to the cash gifts, because this is one of the things that I used in one of my last transactions. The gentleman was qualified for a VA loan, but he didn't have the closing costs. So we were able to use the cash from his mom to help him to close. But for the down payment assistant, can we use any, you know, like, let's just say I don't qualify for the down payment assistance, but I still don't, let's just say that my credit is 610. What can I do with, and I have grandma, mom, and an uncle who all promised to help. So tell me what I can do.
Absolutely. That's one of the beautiful things about FHA, VA, and USDA, and even conventional now, is you absolutely can get gift money to help with your down payment and your closing costs. You can pair it with even the down payment assistance program. So let's say, for instance, you have somebody who's getting the 5% in down payment assistance, but the seller is not willing to help with the closing costs, so they still have $5,000 or $6,000 that they've got to pay. They can absolutely get a gift from a relative. And again, the way that FHA and these programs define a relative is somebody related by blood, marriage, or adoption. So now they will allow fiancés to give gifts. So that's one thing that they will consider that. So gift funds basically have to be documented with a gift letter that is completed, that is property specific. So the gift has to be for the house specifically. And we have a formatted gift letter that we send out once they're on contract, that they then have their donor sign, and then the home buyer signs. And it lists the dollar amount of the gift. And then the donor has to supply their most recent 30-day bank statement where the funds are coming from to support the fact that they have the money to give. So the gift letter specifies the dollar amount. It specifies that it's going towards the specific property. It specifies the relationship: mom, dad, sister, brother, aunt, uncle, grandma, grandfather, aunt, uncle. The only family member who is not allowed to do gifts is cousins. I think that everybody had a cousin at one point, and so they really cut down on that. But, you know, I have had certain cultures where you have like sister cousins and brother cousins where they all grow up together in the same household. So even though they're cousins, they really fall under sister brother. We have had some exceptions for that. So again, we're going to look at each case, you know, on its own accord. But absolutely, it can be for the full amount. There is no cap on the amount they can give. FHA, if you have a buyer who maybe has low scores and high ratios, and maybe the automated system wants them to have 2 or 3 months of house payment and reserves, gift money can cover the reserves as well. So the reserves can cover down payment. The gift can cover the down payment. The gift can cover closing costs and prepaids, and the gift can cover reserves. That's eligible on USDA, VA, conventional, and FHA financing. So there was a time years ago that on conventional loans, the buyer had to have 5% of their own money before any gift monies could apply. But probably about 5 or 6 years ago, Fannie and Freddie lightened up on that and opened it up to where, I mean, you can get gift money on those. The only time that gift money cannot be used is if you have an investor who's buying investment property. You can't have gift money on those transactions. It's got, because again, if you think about it, it's an investment. You shouldn't be investing if you don't have the money to invest. But that's another topic that we could get into.
So if, let's just say that I don't qualify for a down payment assistance, I'm at 610, right? But my mom, everybody is willing to help. Can they give me both the down payment and the closing cost, or is there a limit? Okay.
No, and you can have more than one donor. I mean, I've got some
Okay.
buyers who had a gift from mom, a gift from the grandparents, a gift from their uncle, you know, in some instances, and this is more of a rare occurrence, but in some cultures I've run into where the church helps with down payment assistance, and the church is a nonprofit organization. So as long as it's not a one-time deal and the church can show that this is part of their ministry, is to help their members with down payment on new homes, which we have a particular group of people that the church that they belong to, that is the case. So that's also something where we've been able to get gifts in those situations too.
So there is no maximum true on cash gifts, right? Cool.
No.
Well, that's actually a very good news for a lot of people who do
It
have
really
extended family who may not want to be able to, you know, put themselves in a cosigner, but they're like, sure, I'll give you $5,000. You know?
Absolutely. And we've run into that many times. And the thing is, you know, and I think we touched on it a little bit, but just to clarify, I mean, zero down payment doesn't mean zero out of pocket, right? So
which is actually my next slide. So can you expand a little bit more on that?
Yeah. So basically, I mean, people need to understand. So you have three elements to your out of pocket on a home purchase. You have your down payment, which is the money difference between your purchase price and your loan amount. And
can you give me an example? Let's just say that the house cost $100,000, right? Let's just make round numbers.
So let's say,
100.
Yeah. So if the house costs $100,000 and they're putting 5% down on conventional, that's a $5,000 down payment. Okay, so that's just their down payment. And conventional, for instance, they have 3% down options too. So if it's a 3% down, it's $3,000. If it's FHA 3.5% down, it's $3,500. So basically, the down payment is just the difference between the purchase price and the loan amount. So it's money that the buyer is putting down towards the house.
So for those of you who are very math challenged, and I have a lot of people who are math challenged, whenever you see a down payment that says like 3% or something like that, you need to pull out your calculator. Don't just look at it and say, I don't know what that means. Pull out your little phone calculator and say total house price, $200,000 multiplied by 0.035, 0.0, or something like that. That's how you calculate your down payment, because a lot of people are mystified by the down payment.
Right. And it is basic math, but yeah, if you're not in it every day, we lose what we don't use. So yeah, but it's just a percentage. It's a percentage of the purchase price that you're putting down in cash before your loan comes into effect. So you have your down payment, that's your main element. And then you also have closing costs, which closing costs are going to be your lender fees. Typically, there's going to be an origination fee. There's going to be underwriting, processing, admin fees. Those are the cost of doing business with the lender. Depending on how that lender is structured, the fees are going to be a little bit different. A broker's fees are going to be a little bit less because they don't have staff. They're dealing with the wholesale. They have no control over the process. Whereas a mortgage banker that has, assistants and transaction coordinators and processors and underwriters all internally, their costs are going to be a little bit more, but it's because they've got complete control over the process and are doing everything in-house. So understanding kind of those differences, and when you're looking at closing costs. So you're going to have your lender fees, and then you're going to have your third-party fees, attorney fees for doc preparation and doc review, your credit report, your appraisal, final inspection if the appraiser calls for any repairs to be done, flood certification to make sure you're not in a flood zone, tax service fee, which has to do with tax reporting that lenders have to do, to the IRS every year for the loans that they close. You have title company fees, your title insurance, your owner's policy and lender's
title
policy.
Insurance is a big one. Title insurance is a big one. It's not a small fee.
Yeah, it's typically about 1%. And in a lot of cases, and especially in Texas, it's kind of customary for sellers to pay for the owner's title policy. But right now in a seller's market, sellers are not
Don't even mention it yet. Don't even mention that.
Yeah. So, I've seen the difference between somebody getting a contract and somebody not winning a contract is whether or not they want the seller to pay title or if they pay it themselves. So
I won the last 3 contracts by not asking the sellers. So
yeah.
last 3 times I won a contract simply by telling the sellers we're not going to ask for a title, and if the survey comes up, we're going to pay for our own survey.
Absolutely.
And they're like, done.
And it makes a big difference when you're going into a multiple offer situation for sure. But yeah, so title insurance is a big one. And of course, survey you mentioned. And now a lot of times, you know, places where you can save money is if there's an existing survey that's done within the last 10 years and there haven't been any changes to the property or the property lines, they haven't added a pool or an outbuilding or anything like that, you can use the existing survey. So that can save both buyer and seller about $500 if a new one's not needed. But then you're going to have the title company escrow closing fee. That's their fee for their services, courier fees, recording fees. If there's a homeowners association.
Now you're scaring everybody who's listening. They're like, so how much is the total? Because it sounds like a lot. In fact, some of those fees are quite small. Like I've seen $12 for one fee, $7 for another. So a lot of people listening are like, oh my God, I'll never be able to buy a house. So what would be the rule of thumb for them? So let's just say that assuming that we don't have the, assuming that they're able to get to 0 down, how much percentage-wise, just very generic number? Assuming we don't have an FHA, assuming we don't have a homeowner association. So just throw the homeowner association out.
So as a general rule of thumb, what I prepare people for is the total of closing costs and prepaids, because I don't want to just say closing costs, because the prepaids is the third factor, right? The prepaids, that's your first year's homeowner's insurance, your daily interest from the day of closing through the end of the month, and then your real estate taxes to set up your escrow account. So closing costs and prepaids as a general rule are going to be anywhere from 4 to 5% of the loan amount. And it, depending on the product and the program. So, credit
so if we have a $100,000 house, let's just calculate really quickly for our listeners. Let's just say $100,000 house, we were able to get a 0 down loan. Now, how much do they need, in your opinion, to save for the prepaids, or not for the prepaids, but for everything else other than down payment? Yeah, closing and prepaids.
Yeah, I would probably say anywhere from $4,000 to $6,000.
Okay, so if we have $100,000 house, then you need to worry if you're, thank God, able to qualify for down payment assistance. You still need to consider the closing and the prepaids, which can run between $4,000 to $6,000, depending on actually the location, because the taxes are different everywhere. But this is why your cash to close is bigger usually than your down payment. So what I see a confusion is people say, how much is a down payment? I'm like, well, it depends what your program you qualify for. You should be asking me how much is cash to close.
Yes.
Right? Versus how much is the down payment. So on the cash to close, just to wrap it back to our previous slide, we have 2 types of costs: the down payment and then cash to close, which is usually larger than the down payment. The cash to close will include the down payment, the prepaids, and the closing costs. If the down payment is taken care of for you by some kind of a program that you were able to qualify for, you're still on the hook for the closing costs and prepaids, unless you have a way to get that burden alleviated by either having the seller contribute to your closing cost, which in this market, I will be honest with you, not going to happen. We're in a very hot market. Or having cash gifts from your family or other types of entities contribute to your closing costs, not your down payment. Your down payment is already taken care of, your closing costs. Lots of confusion about that.
And the other thing too, while we're talking about just eligible sources of funds, because some people may or may not know this. So eligible sources of funds are, of course, checking and savings, gifts from family members related by blood, marriage, or adoption. You can also pull money from your retirement. A lot of times you can
let's talk about that real quick.
Yeah. A lot of times you can do a hardship withdrawal if you're purchasing a home, to where you don't have to pay your penalties. You still potentially have to pay tax on it, but you don't have to pay the early withdrawal penalties. They'll let you do that one time. The other thing is you can actually do a 401k loan, and that 401k loan is not counted in your debt to income ratios because you're paying yourself back. So that's a way to pull money out at a much lower interest rate to cover your down payment or closing costs, leveraging money that you've already saved, but paying yourself back versus just pulling it.
That is completely new information
Yeah.
for me.
Yeah. Well, good.
Because I have had sellers, buyers who would not buy a house because when we calculated their cash to close, it was a little bit more than they could pull right now. And then none of their parents was able to help. And had I known about that loan to your own 401k, we could have saved the transaction.
Absolutely. The other thing too is stocks. Like if people have stocks, they can sell stocks. That's eligible. And
Bitcoin counts? Does Bitcoin
so
count?
yeah, I actually have a client right now who has a bunch of money in Bitcoin, and all he has to do, he's got to show us the cash value and the liquidation and conversion of it into US dollar, and then show that in his bank. So absolutely,
I love that. Okay.
I know we are constantly evolving society with new ways of tender, right? Money back and forth. The other thing too, and this one's a little bit obscure and a little bit more challenging, but it's good information to have. So let's say somebody owns an RV or a boat or something like that, but it's something that's valuable, or maybe
it's actually very common. A lot of my buyers are currently living in a RV or in a trailer.
Right.
Okay.
So if they own something like that, that their plan is to sell that. So that's collateral that they can prove a value on, they can show a true bill of sale on, and they can sell that collateral for eligible funds to close.
Can they sell a car?
They can. Basically we just, like anything, we have to document the paper trail. So we have to show that they have the title to sell it. We have to show the bill of sale, and it can just be a Word document signed by the buyer and the seller showing I agree to buy this car, put the VIN number, they put the dollar amount, and then we get a copy of the money order or cashier's check from the buyer to the seller. But and then we have to pull the Kelley Blue Book value to make sure that what they sold it for is in line. I've had clients that actually have gone to CarMax and have sold a car to CarMax and have gotten cash that way. So there's a lot of different ways. There are so many different ways that are eligible. That's why I tell people, talk to us, ask us, and then that way we can give you guidance based on your individual situation before you just rule something out because you think it won't work, or before you do something and try and hide it because you're afraid it won't work. I've had people do stuff like that, and we end up then having to backtrack. And it's a lot harder to backtrack than it is to do it right the first time. So I just tell people, just be very transparent so we can walk you through how each type of funds needs to be documented in order to meet the guidelines.
It's called sourcing. And I have found the hard way that sourcing is important.
Which that leads me into my very next statement is the only thing that we cannot use is cash. If they've got cash at home,
which is exactly what I had to deal with, because that person withdrew. He thought that the world was ending due to, some prediction from the religious leaders. So they withdrew all their money. They had it all in cash. And now we suddenly have to buy a house.
Yeah, that won't work. I mean, that's probably the only time that cash is not king is if you're trying to buy a house. And it's basically because we have to be able to document and source everything. We have to prove that money is from an eligible source. We have to prove that the money really is, in fact, something that the buyer has rights to, that they're not getting an interested party contribution outside of the contract, that the realtor or the seller or the lender is not giving them some sort of financial kickback as a straw buyer to buy the house. We have to make sure it's not coming from any sort of illegal activity or terrorist activity. So there's a lot of reasons why we can't use cash.
So no money laundering, right? No money laundering.
Exactly. Seriously. Yeah. I mean, that's really what it comes down to. The other thing too is, like, if you have a buyer who's got cash on hand, and they need to get that money in the bank and let it season for 2 months. It needs to season for 60 days. Yeah.
Okay. Gotcha.
It needs to be in the bank for 60 days. Any large deposits that are not payroll, and large deposit is anything over $100 in our terms, has to be documented and sourced, or it cannot be used.
So if they're homie back way from, Arizona or Michigan, tell them, hey, you owe me $5,000 and I'm about to close. I need that money through, wire me some Western Union. That won't work, right?
That will not work. No.
Okay.
Now, if that person is somehow related to them and is going to gift it to them and can show us they've got a 30-day bank statement, then we might be able to get through it as a gift. But if it's cash on hand, if it's cash in the coffee can, cash under the mattress, cash in the safe, if it's cash, we cannot use it. There are no
Okay.
exceptions to that.
Okay, gotcha. Alrighty. Let me see. So down payment, is it a good idea or a bad idea? We touched upon it at the beginning, but now we have actually more people joining us. So why don't we go through a lot of people, like I had people who are making probably $400 per year. And they asked me, well, can I qualify for a down payment assistance? I'm like, with your income, I'm not so sure, but why would you want to? And they'll say, well, I don't want to, you know, I want to hold on my cash. I'm like, that's not always a good idea. So tell me when the down payment assistance a good idea and when it's not.
So, and this is from 22 years sitting on this side and working with hundreds, probably thousands of families at this point in my career. There are times that down payment assistance is the only path towards homeownership. If it is the only path towards homeownership and you qualify for it, absolutely, it's 100% great idea, because it's always better to start investing in your future than it is your landlord's. We are all paying a mortgage payment. It's just whether or not we're building our equity or if we're building somebody else's equity. So 100%, anything you can do to help get yourself into a home where you are building your equity and your future, absolutely, it's the way to go. Now, if you have somebody who has 20% down or even 10% down, and they've got really good income and they've got really good credit scores, so they're going to end up with a much better rate, then at that point, I really question whether or not it makes sense to use the down payment assistance, even if you qualify for it, especially if it's a down payment program that you have to pay back, or if it's a down payment program that has a much higher rate, which most of them are going to be a 0.5 point to 3/4 of higher than regular market rate. How long are you going to be in the home? And, you know, so we basically analyze that, because I do. The other thing too is purchasing power. The down payment assistance programs, especially, you have caps on what the debt to income ratio are that are lower than what the regular programs allow. So for instance, I issued a pre-approval yesterday on a client and they qualify for both down payment assistance as well as regular FHA. The regular FHA rate for them was at 2.75. They've got the 3.5% down. They've got enough to cover their closing costs and prepaids and still have plenty of money left over. So comparing, and that allows them to get up to about a 325 purchase price, because I can take their ratios higher. On the down payment assistance program, they were limited to 290, which is a big difference in house. 325 to 290 is a big difference in what you're going to get in house. And they would be at a higher rate. And on that particular program, the one that they qualified for, they were going to have to pay that down payment assistance back. So it'd be one thing if they qualified for like the 5% down payment assistance that's forgiven after 3 years, that really is kind of like free money. That it might make sense to go with a lower priced home and knowing that you're going to not have to pay $15,000 back, right? So we're really going to weigh each client. We're going to educate them, let them know this is what you qualify for. These are the pros and cons in each. How long do you plan on living in the home? And match them up with the right one. But ultimately, they get to decide which program they want to go with. But no, it doesn't always make sense to do zero down or the down payment assistance programs if you have the resources to do them yourself. The other thing too, I wanted to point out on USDA, and of course, I just had this thought in my head as we were going through the down payment assistance programs, and I might have to come back to it because I lost it, but there is something about USDA I wanted to come back to.
Now, while you're thinking,
yeah.
go ahead. While you're thinking, let me throw it out there. Sometimes people say, well, why shouldn't I use it if it's available to me? And I said, well, I do not know. I'm not a lender. I'm not a money cruncher person. I'm a realtor. And from a standpoint of a realtor, when I present a deal to the seller and it shows the down payment is 0, I'm having a little bit harder time to convince the seller to choose my deal. Why? Because we may not be able to close.
And that's a really good point, especially when you're going into a multiple offer situation. Financing can make or break a deal. And I've seen this a lot of times. If I've got a buyer who's on down payment assistance and needs the seller to pay their closing costs, and they're going up against conventional offers and cash offers, and even FHA offers that don't need the down payment assistance, they're going to be at the bottom of the stack. They will be. So that absolutely can make a difference. And I mean, a seller from their side. They want as much money in their pocket as possible. So they're going to go with the deal that's going to get them there. The other thing too is if you have somebody who's at 0 down and they're pushing the top end of the price to maybe get some seller concessions, and then that house doesn't appraise, if they don't have the cash to complete the deal, that puts the seller in a bind too, because then they either have to come down on the price or it busts, and then they've got to start over. So appraisals definitely play a part in 0 down versus 20% down too. And again, especially in a market that is moving very quickly and values are going up and sellers are seeing multiple offers, all of that plays a part.
So for all of you listening, 0 down is great when you consider that you got the money, the deal in the bag, but you don't have the deal yet. Before you can buy a house with 0% down, you need to actually win a negotiation with the seller, and that's a whole different story. So a lot of people latch on to the idea of 0 down because they're completely oblivious to the rest of the picture. The fact that they might have to bid on 20 or 50 houses before somebody accepts their bids, and it could be extremely time consuming to go from house to house to house, bringing your kids there, bringing your mom-in-law in there, liking the house, and then being rejected for the offer just because the seller doesn't like the fact that you don't have a lot of cash because they're worried that you might not be able to close. So that's one from my standpoint, a big deal breaker, because when I submit an offer on a house and they see an FHA, usually the lender phones me and say that a DPA kind of a deal. And I said yes. And they're like, okay, well, thank you for letting me know. So DPA, just for those of you who don't know, is down payment assistance. So go ahead, let's then, anything that you want to add? We have literally 2 minutes left. Anything that you want to add to anybody who's listening right now?
I think we covered a lot. I would say, just my biggest recommendation is don't let fear stop you from making that call to a high trust lender that is referred to you, by a trusted agent or a family member or a friend. Talk to somebody that has a track record for these types of programs and is going to help you. But, and then whenever you do talk to a lender, just be transparent, share the whole entire situation. That way, if you have a secret second income, don't count on it to suddenly. I have people with secret second income who didn't disclose it until we were already under the contract. I have seen it happen so many times. Just, talk to your lender just honestly and transparently so that they know how best to advise you. There are very few situations that we don't have a solution for, but we do not want to all of a sudden halfway into the process after they've spent inspection money and appraisal money, find out that they have a child support that never was disclosed. And all of a sudden underwriter sees it on a bank statement. Recurring, those are things those are the gotchas, right? We want to know up front what all the hurdles are so that we know how we're going to clear each one throughout the process. If we know what's going on at the beginning, we can take you through it successfully. But if we don't know, then you're only doing yourself a disservice, and it's going to cause a lot more stress and anxiety and could cost you the deal depending on what the situation is. So, but we could do a whole series on like the do's and don'ts. And that would maybe be
I think it might be a good idea. Yeah, do's and don'ts. Because I have so many frustrations with people who are hiding information from their lender. They're telling it to me, and I'm telling them, you really need to talk to how we're going to pull it through, because the underwriters are not going to like it at all. So for those of you who are listening, Katie, so the lady who is talking is Katie Andy, in case you missed the beginning of our talk. I am sending pretty much all of my buyers who are first-time buyers to Katie, even though I know a ton of other lenders, because Katie is the one who I feel will take the time to understand the situation and not screw us over because they just want to issue a quick pre-qual. And then with that pre-qual, I feel that I'm not even sure if we'll ever be able to close. Also, when you're talking to a lender, I tell my buyers, pretend that you're talking to a doctor. Pretend that you're talking to a doctor. Be as honest with your lender as you would be with your doctor, because the lender is not going to judge you or not going to run around and report you anywhere in case something does come up. But if you're counting on some information that the lender doesn't know to help you to close the deal, this might be a false hope. You might be setting yourself for a very big failure.
Yeah,
but
absolutely.
That's about But that's about it. Speaking of Katie, you will see my information on the video, so I don't need to introduce myself again, but I really, really, really want you to write down Katie's, and I'm going to put Katie's contact information in the description of this video below. So don't worry about, jotting everything down. It will be in the description below. Follow up, I'm going to send everybody an email with the recording of this video. The video recording will have all the information you need to contact Katie. If you're thinking about buying a house in 2021, do not, and you think that I have until November to buy a house, right? Do not wait until mid-October to start buying a house. That's not how it works. Contact Katie today. Contact Katie 10 months in advance, especially if you feel that you have some hurdles with your credit or anything like that needs to be overcome. Let Katie tell you how you can prepare the best, so by the time November comes, she is fully in position to give you the loan that you're hoping to receive. With that said, Katie, anything else you want to add about Interlink Mortgage? From what those of you who just joined us recently, you did not hear Katie mention a very specific type of a loan that I never heard of that can help you maybe to finance your first house. How is Interlink Interlink Mortgage different from other mortgage companies?
So Interlink Mortgage, we're a full service mortgage banker. So everything we do is in-house, all of our processing, underwriting, closing, and funding. We sell directly to Fannie, Freddie, and Ginnie, which means we don't have a lot of overlays. If the credit scores are there and we have automated approval, we're able to move forward. And then we also do have, of course, FHA, VA, USDA, conventional loans. We have jumbo loans. We have renovation loans. And then one of the new products that we rolled out last year that was really exciting is we do have 100% conventional financing, no mortgage insurance. It's a private money loan that we underwrite internally. Yeah, maximum.
No mortgage insurance.
Yeah, no mortgage insurance.
What you guys don't know, those who are listening, is what she's saying to you: more money for you, less money for them. You're basically going to be saving money. Mm-hmm.
Yeah, because mortgage insurance, you have no benefit. It protects the investor in the event that the buyer defaults. That there's no benefit paying mortgage insurance for the buyer. So if you don't have to, that's better. But yeah, I mean, that's a great product. Like I said, that one, we have a 660 credit score on it, maximum debt to income ratio, 43%. Seller can pay 6%. So it's really strong. And again, we just underwrite it in-house. But the chances are we've got a product or a program that will fit most home buyers. And if they're not ready yet, we can help them at least map it out. I kind of like to say that as a loan officer, I'm kind of the GPS, right? And so we are here to help them map out how to get from point A to point B successfully and within hopefully the time frame they have to work with. And even if credit's not where it needs to be right now, we can give some guidance. We can make credit repair company recommendations. We do have a couple trusted companies that we work with. So, I would just say, don't be afraid of the unknown, but find out. I mean, education's power, knowledge is power.
And money, a lot of money.
Absolutely. But, I'm here to help however I can. I'm happy to answer any questions. You're welcome to call me, text me, email me. And just, let me help you get to where you want to be, but yeah, I mean, if you're buying this year, I mean, starting now versus later will definitely help set the stage for success whenever you're ready to make the move.
Sounds good. Is anybody on the call who wants, you would have to unmute yourself. Do you have any question that we can answer right now before we wrap it up? And if you're muted, then we cannot hear you. And I'll give you just 1 second to unmute yourself. And if there are no questions, let me see. So we have 4 people on call. No questions apparently. In that case, we're just going to wrap up. Thank you very much for joining us. For those of you who are trying to buy your first house, I wish you all of the success in the world. And I'm here and Katie is here to answer all your questions. Thank you so much and have a great day.